Okay, so for S&P 500, you can look at the chart, right? So just like 1 or 2 weeks ago, we are saying that, oh, sky is falling, sky is falling. Even QQQ already entered 10% dip now. Subsequently, it has gone back up again. It's like a V-shaped recovery. You look at the S&P 500 charts here, it's like really you can see a clear V there. And then same for QQQ, it's just that the volatility is a lot higher compared to S&P 500. And then, I mean, my top holdings, Nvidia, right? You can see that it's again another V-shaped recovery here. But this is all short term, right? Because let's say for Nvidia, I think we still need to look at what's the earning results, which will be coming soon. I think it's the end of the month. And then another one of my top holdings, TSMC, also showing like a similar chart pattern, which is like a V-shaped recovery. I myself also a bit shocked with this kind of recovery. It's like I thought that it will, linger around, because all this worry about like Bank of Japan is going to hike interest rate, right? Although it's like just like 0.25% or 0.5%, it's still very low, but I think it's still enough to wreak havoc because of all this leverage in the system. Okay, let's take a look at the economic data. So I think one of the more recent one is the inflation rate. It has came down slightly. The most recent reading is 3.3%. It has came down from 3.4 the month before and 3.5 the month before. And actually, this kind of drop is not new, right? If you look at this series, like a longer series, you've seen that it has dropped to about 3% around mid last year. Then it went back up again and then down again, right? So I think this is one of the data that the entire market is watching, because let's say if inflation continue to cool down, I think that gives the flexibility to the Fed to lower the rate, and that's always good for the market, right? The thing that we worry the most is actually inflation still sticky. Let's say it stay like between 3.3 and 3.8, and then growth rate suddenly slow down, right? I think that's the things that people worry about. As long as these 3.3% continue to drop, let's say if it drops to sub 3%, like 2.8, 2.7, I think that's a good picture to see. This one just shows that the market implied probability of interest rate cut in the future. So this is referring to the Fed fund rates. Currently, we are at 5.25% to 5.5%. So it's like another, let's say if we draw another column, we are currently at 25 basis point above the one that is showing here. So I think the market is already pricing in like almost like a sure thing already. We will get a 25 basis point cut in mid-September. Still 1 more month to go. And then even there's like a 25% chance that we might get a 50 basis point drop. So this one, I don't think it will happen unless really you look at the economic data. It's like everything down by a lot, right? Potentially can get, but I think that's like, I actually assign my own probability of lesser than 25%. I think it is more like a below 10% kind of scenario. But if you look at like, let's say end of the year, right, which is December here. So from now to December, I think the currently market is pricing in 4 rate cuts. So it's like 100 basis point drop. I don't think it will drop as much. It should be, let's call it like 50 basis point or so. But anyway, these are just market expectation. It can fluctuate quite a lot. For example, let's say if you look at the same table just 1 week or 1.5 weeks ago, right? Actually the market was pricing in like a huge drop, maybe 7 rate cut by end of the year. I think that's a bit like, exaggerated. I don't think it will have that kind of drop. Let's see. Come back to local market. So I think this is the 6-month SGS T-bill. I think quite a number of you, I myself included also, like put some money into T-bill and then just, treat this as like a high interest saving account, right? I think the most recent auction, you can see that the yield actually has came down. So it's currently at about 3.34%. I think assuming that this whole thing about inflation cool down and then US cut their rate, I think Singapore T-bills also will be affected now. For those who are rolling your T-bills, if you have like a sizable amount into T-bills, right? I think the risk is that whenever your old T-bills mature and you need to roll, just be prepared that you might need to, like subscribe to like a much lower interest rate. So that's the risk of, having too much into cash. It's good to have some dry powder, have some cash, have some money for emergency and so on. But if this amount get too big, right? I think the risk is that you might not able to get the yield that is satisfactory. I mean, what happened in the past, let's say like 2 years, right, is all good. But don't forget that this is, it's more like a temporary kind of situations because US Fed need to hike the rate to cool the inflation, right? As soon as inflation down, right, there's no reason to keep the Fed fund rates or all these, short interest rate to be at this kind of level, like let's call it 3.3%. I don't think it can stay that long. So just remember that. Then, of course, quite a number of you also subscribe to, Singapore Saving Bond, SSB. So this one I pull out from I Love SSB website. I think it's very useful. It actually do all the calculations for you, and then you can just use just looking at this, you know that what is the interest rate that you will get if you subscribe by end of the month, which is on the top table. So for 10 years average return, right? If you subscribe by 27th of August, you will still get 3.1% average for 10 years. If you look at the 10-year spot rate, right? 10-year Singapore government bond yield, right? Is already around 2.8%. So what it means is that, let's say if you subscribe next month, right, you'll probably get something like 2.8%, which is shown in the projected table down below here. My plan, right, for SSB is that I have like very little SSB. I think it's like few thousand, maybe up to like 10,000. It's like a very small portfolio. It's really for emergency cash. So it's a very small portfolio. But my plan is that I probably will take some money and subscribe to SSB by end of the month, so that I take advantage of this 3.1%. To me, 3.1% is not super attractive, but it is still a good place to put your money. Let's say if we want to, keep some dry powder. My dry powder is still still a fairly small amount. That's why I think it's okay to keep some more, because I think market valuation still seems a bit high. Lastly, want to share that this interview that I watched, 1M65, I think Mr. Lu interviewed Chris Tan, the CEO of Provident. There are 4 videos, 4-part series. I watched all of them. I think this is really a good interview. You can watch it. Just to do some reflections on all these, watching these videos, right? I think the one sentence that came from Christopher is that he mentioned all this talking about investment returns. Sometimes you don't need like the maximum returns, right? For example, like just now I talked about T-bill. Sometimes we hold all these T-bills, it's not really like, I think that the market will crash and then I can do like a fantastic market timing. So even I hold T-bills, it's going to, make my overall returns to be higher. That one sounds like, sounds too good to be true, because let's say if we have like bigger or sizable portfolio into all these T-bill or bonds, this is not really to maximize the returns, right? This is really to, stabilize our returns so that we still, stay objective and not getting too emotional during a market downturn. I think it's very helpful in terms of managing our own emotions. So sometimes it's like you need to have enough, to me. That's my own reflections. Like in terms of my decisions, you can see that, having some money in T-bill, some money in SSB, sometimes it's really like we do that and we tell ourselves that actually given whatever, let's say like our saving rate, our money to fund our lifestyle, sometimes there's a level that you yourself are comfortable with. And then with that, right, when it comes to investment, sometimes you don't need to always maximize, always optimize everything. Just keep things at a reasonable, at a more like a neutral area, so that we know that, let's say if there's any market downturn, we won't be that worried because we have some dry powder around, right, that we can deploy. So I think that's very important. So I mean, for those who have some time to spare, all these 4 videos added up together, I think it's like less than 1 hour. It's highly recommended. Okay, so let me give a shout out to Webb, which is my friend in Telegram group. So he's kind enough to say that, this is, this Slido things is kind of fun, where we can, just ask people to post questions. You can direct to myself, you can direct to Webb. So it's just quite a fun thing to post questions, post topics, and then we can have live conversations like this, right? So I think Webb has been replying to some message in Telegram. Let's say if you want to join all these discussions, right, you can of course join our Telegram group. I'll put the link at the description. And let's say if you join, right, usually I will I saw someone request to join the group, I would just go and PM. So at least set your Telegram setting so that I can reach out to you. We just say hi, just to confirm that you get the link from YouTube, and then I'll just approve you to join the group. Okay, to Raining Gold. Since FIRE for so long, do you feel bored and uncertain about the purpose of life? If you have figured out, can you share your thoughts? Or at times you feel could have been more contributions to the world or society by returning to work? I think that's good questions. I think these questions is also, I think, one of the mostly heavily discussed topic, at least in the FIRE community. For those who, they save enough money, they just want to retire while they are young, and then maybe they have some dilemma on whether they should, go back to society. Because I think for those who are in this, FIRE movement, right, my observation is that some people, they really like did very well in terms of their financial. They prepare everything. They can, like just having spent like 2 to 3% of their portfolio, still they can have a lifestyle that they are comfortable with, right? Some people actually, I noticed that they struggle in terms of like they kind of like after they stop working, and then it's a bit like detached from the social, because for those who are working, right, work sometimes is not just the source of your income, right? It's also the source of your social, your friends. When even if you chat with your friends, also you talk about works and so on. So if you cut this out, right, the work part out for long enough, right, sometimes of course there will be some feeling of you are dissociate yourself from overall your social life and so on. So I do see that some of the people have this problem to get into retirement lifestyle. I think this one requires some time to adjust and so on. Okay, that's on the first question. Second one, Boon Tee, how have your life changed since you become so famous? Is it difficult to go out? Is it you wear sunglass or cap or mask when you go out? Okay, so I think one caveat, I've never feel that I'm famous. The only time that people reach out to me and they say they know me is really when, let's say, I join Sydney event, those financial conference event. Some people will say, oh, I watched your video, bet holder video and so on. I think other times not so famous. Like I would say, let's say when I go out, I don't even feel that people like notice me. So I'm just like, like small YouTube account, right? So not famous, I would say. And let's say if you see me on the street, just come and say hi. So I will be very surprised if someone come and say hello, because I haven't experienced that often. So not a problem for me, okay? Nothing to adjust, nothing to comment here also. How do you think about risk in investing with respect to justifying if you should take or not taking the risk, and also risk of omissions? Is there a definition or concept that you keep in your mind? Good questions, but I struggle to give a good answer. I'm not like a portfolio managers. For portfolio managers, their mandate is very clear, right? Say for example, their benchmark is S&P 500. So day in, day out, they are thinking of how to best position the portfolio to at least do as good as S&P 500. And of course, they should strive to do better than S&P 500, right? So there's a lot of questions that coming when they are managing their portfolio. So let's say every position, right? Let's say they overweight into allocate certain allocations into one company, right? They need to be sure that, okay, this company is at least better than average, right? Because if you overweight into a company that do, let's say, like 5% over the next, let's say, 3 years, right? But the market go up by, let's say, 10%. So we will lose out. So when it comes to all these portfolio managers, I would say that their focus is really like, I want to play to win. But now come back to myself, right? I'm not a portfolio manager. I can afford to, pick companies that I know that it's not going to give me a high returns. For example, I think that it can give me 5% return, but I'm happy with that 5%. For example, sometimes this company or position, it could be something that is more stable. Like you don't see like you are not betting a lot, right? So, and you don't bet on things that will change, right? Like you also mentioned in the Telegram group, right? So these kind of things, as a individual or a retail investor, we can actually position our portfolio in a way that not necessarily win S&P 500. We sometimes play defense, right? So we play not to lose. So I'll give one example of, let's say if I'm putting my money in REITs, right? You look at the REITs returns, the dividend yield, let's say is like, let's call it like 5%, right? When you invest into these REITs, I don't think it's reasonable to expect that you can get something like 8%, because between the dividend yield of 5% versus the 8% that you are expecting, right? Where's the additional 3% will come from? So if you are thinking that, oh, the valuation is very low, I invest in these REITs, I get 5%. At the same time, all these properties that the REITs own, right, will go up by, let's say, another 4% or 3%, right? So then you say that, you just break down the return, 5% coming from the dividend, and then another 3 or 4% or 5% can come from appreciations of all these holdings, right? Then yes, that could be the argument, right? But sometimes when I'm thinking about this, right, some people, they will say that actually I don't need that. Even if all the real estate prices stay at current level, right, I'm happy with that 5% because my portfolio is sizable enough. I just don't want to take on too much of business risk. I just want to hold like real assets. That's good enough for me. So I just position accordingly, in a way that really just fit my style, and then something that I'm comfortable with, then it's just, good to go ahead, right? In that way, what kind of risk that we are taking, it has to be aligned with our investment objective. So let's say, for you, right? Let's say if you are investing other people's money, you need to really understand what's their expectations, right? You could have like low expectation when it comes to the returns of the holdings, right? But your clients or your customer may not necessarily agree, right? Because they put their money into with portfolio managers, they want to see outperformance, right? If it is lower performance than S&P 500, they could say, why should I put my money with all these funds or all these portfolio managers? They want to really like put their money to maximize returns, right? So this whole thing, I think just to conclude, right, is that we really need to know what's the objective of our investment, our strategy. If you are very clear with the objective, and you are very clear with the strategy, right, then you can position accordingly in such a way that there's not much, conflict. When it comes to like what kind of risk to take or not to take, I would say number one is that you have to fit the objective, you have to fit your overall strategies. That is number one. And then for me, right, I'm quite comfortable with taking risks as long as I'm able to convince myself that this company that I'm investing in terms of their business model, in terms of their quality, in terms of their management, they are good, okay? Then I'm just like, put my money in. So I'm not thinking that, let's say I put my money with TSMC, what kind of risk that I'm taking? I'm taking the risk that maybe semicon will slow down, maybe they will lose out when it comes to competition and so on. Of course, all these risks is part of parcel of this investment, right? But when it comes to the decision making, I don't think so much about all those things, because I think this, even if I do my analysis is like 10x of whatever that have been done, right? Still, you are taking the risk, right? So to me, it's like risk is always there. I just need to convince that the company is well run, the business model is good. I can hold this portfolio for a long period of time. I am patient enough to hold. I think that's good enough for me. So I'm not thinking too much about like the type of considerations that typical portfolio managers might have. In your investment, how do you reconcile with the need to change your mind when facts change? How do you break your thesis without holding on to mental biasness? So I think these questions also related to my previous response in terms of things that I observe and I monitor, right? They change very slowly. It's very, very slow one. For example, I've been talking about like investing in Apple. People talk about Apple is technology company, but to me, right, it's not so much about the technology part, because if you talk about technology, actually other companies also have the technology, because if you compare Apple versus, let's say, Android phones, right? Apple, they come up with iPhone. Android phones, of course, that's software part, but they also come up with their Pixel phone, right? In terms of technology, both of them are able to create phones. There's nothing much about the technology that really, separate them from others. But why, let's say, when it comes to phones, people always recognize that iPhones is better as compared to other phones. Okay, I'm not trying to trigger those who are using Android phones here, but just follow this discussion here. So actually, for example, take Apple. I would say that what separates them from the others is actually their culture. One example is that their attentions to details. So, when they're designing all these phones, you need to have all these software, hardware integrations, and as simple things, as simple as, let's say, just notifications, right? How it come in, and then whether you saw the notifications or not, and then it just disappear from your screen. Things that pop up on those who are using, let's say, Apple Watch, how many seconds it will disappear. All these like tiny things, right? Actually, this is where Apple is like extremely good as compared to others. That's why whoever that use Apple products for sometimes they switch out from Apple. Usually they struggle, because even small things like this, right? Other competitors, right? They are usually not as detailed. So their product is also not like as good as Apple. So I would say that this kind of things is really, is tied to culture. Sometimes if you monitor long enough, let's say like years, right? Of course, all this culture, it would drift. I'm not saying that culture will just, stay 100 years, won't change. Not like that. It will change. But they don't change from one quarter to one quarter, right? Because if you separate things that will change, right? I would say that the stock price definitely is the one that changed like very fast. Every 3 days, let's say if you go for a vacation, you come back, suddenly, share price already jump, already drop, already crash. Like recent 2 weeks ago, right? Crash big time. Now it's like, crisis averted. So I mean, all these price can change very fast, right? Then secondly, if you monitor all the fundamentals, right? If you observe the earnings, you follow the revenue and so on, all these fundamentals also change, but they change from quarter to quarter. And then lastly, the things about like all this culture, about their business model. By the way, great discussions of all the Airbnb discussions. I do think that these kind of things like culture things, right? Business model, their modes, right? All these things, they also can change, but they change very slow. So you can take your time to, study, to think about it, and then just monitor along the way. They don't change They don't change in 1 year time one. They change very slowly. So you can take your time, and you don't have to invest too much time also, because you are mainly reading things that are very stable in nature, right? So you can take your sweet time to monitor. So that's why I will say that facts usually, by facts I mean things related to all these long-term things, right? They change very slowly, so not a big issue. But let's say if you are referring to facts like, let's say, fundamentals, right? To me, I give like a smaller weights into all these so-called facts like fundamentals. Let's say if 1 quarter earnings not so good, I'm quite patient with that now. So I won't change my mind just because of like 1 quarter result is good or bad, right? That part is fine. But actually what will change, right, is our own perception or our understanding. Because, for example, if you follow my style, if I really want to invest time to know about one company, I will just invest some like small percentage, and just so that I have some incentive to follow the company. But usually after follow for a couple of months, couple of quarters, sometimes it's not the facts has changed, right? It's just that my perception or my feeling or my understanding of the company has changed, because I might discover that actually this company, when it comes to their modes, it is not so strong as compared to other companies. So I might just sell my positions and I move on, right? So that kind of things I will still do, but it's really what has changed. The company is still the company. It's just that my understanding can change. So I think 2 years back, when I liquidated my portfolio, a couple of my positions. Say for example, I think at some point I also hold CrowdStrike, and then I also have C Limited. A couple of these companies I actually sold out, right? Because to me it's like it's a small positions. I just don't think that I want to follow that many companies, so I can make changes to my portfolio, right? But I would say that in the past one year or 2 years, it's less and less I carry out this kind of activities. My portfolio is really like buy and hold. In your investing career, has any of your past thinking or bias been proven wrong in a negative sense? Did it change any of your perceived ideas in a big way? I would say yes, definitely yes. After all, I have invested in stock market for 15 years already. Since I graduated, I already started buying stocks. And of course, if you monitor my behavior or my attitude back then, right, versus now, of course, they are very different. Because when I just, graduated, I just want to buy companies and thought that I can become Buffett like that. So that was the kind of attitude and thinking of someone who is rather young, right, and don't know about the investing world so much, right? So I think all this, with experience, our attitude, our thinking also change from time to time. So I'll give a few examples of what has changed the most, comparing I myself now versus, let's say, 10 or 15 years ago, that versions of myself, right? Back then, I still thought that, let's say, like a PE, all these things is really good. Like we buy a stock, right? The PE is 8 times, meaning that, the earnings yield is 12%. I just need to hold these companies for 3 or 5 years. Of course, I get the earnings yield and I can have that kind of 12% returns, right? That's my thinking back then. I think even when I came to Singapore, I invested in all these like small cap value stocks. There's one, I think the name is Dutech. That was some years ago. So I bought into those companies also because the PE was low, and then I think it's good. Just nothing need to change, right? Just hold on. You hold on to that, you get the earnings yield, right? So that was my thinking back then. These new tech companies that I invested, right? I held for some time. At some point, I really think like, okay, actually, what's their business, right? So for those who don't know, right, this company, I think they in terms of their business, they are selling ATM box, like the safety box or all these things, physical one. I think those are their core business. During COVID period, I was thinking, oh wow. Now the world has changed, right? Do we need that many ATM machines around? Because you can see that, everything's just go digital, right? Even the mobile payment experience using phones, right, also changed quite a lot. Let's say if you compare to 5 years ago, it is like in terms of user experience, getting a lot more seamless. Like after a meal, you want to transfer to your friends, it's just like a couple of clicks. Of course, there's still room for improvement, but I would say that it's already quite good. To the extent that actually I notice myself, right? Actually, how often I go to ATM, right? It's not that often because a lot of payment already use e-payment to do it. So I mean, in terms of the cash usage, right, getting less and less. I'm just thinking, right, like this company like this, of course, it is value stock, PE very low, but the earnings is not something that we can bet on, like it will just stay there because this is not a growth industry. This is a sunset industry, right? After that, I mean, after quite some time, I figured out that I cannot invest my money into all this, sunset industry. Right? I need to position my portfolio in a way that is taking advantage of what are the new areas or what are the growth areas, so that at least the capital that you put there, it can generate a higher return on capital because those are the like the new industry. Those are the future, right? So that's why if you compare my portfolio back then versus now, I try to position more into like companies that's more towards like tech, towards some things that is like really in the future. Even let's say I won't invest my money in Toyota, right? Even they are like one of the best automakers out there. Just because I think that if you look at the future, just 10 years ahead, right? Do you think that the electric vehicle is the future, or do you think that all the ICE, basically all these gasoline cars, are they still around or not 10 years later? So we need to position our portfolio accordingly. So that's why there are some thinking that I kept back then that at some point I just changed my mind after reading all these books or talking with friends. I have all these different absorb different materials, and my thinking also changed from time to time. Of course, you cannot pinpoint which period because to change one person's mind, right, it's not as simple as you just read one article then you change already. It's not like that one. It's really by talking with people, by like challenging each other, by voicing up your opinions, then let other people challenge you, and then we have all this back and forth discussion. Then slowly the mindset or the thinking will drift, and hopefully it drift towards the direction that actually will make our portfolio return better, right? I think that's the things that we strive for now. And by the way, like even let's say my current portfolio, right, the book that I read, right, that actually shaped my thinking a lot is actually The Fall by Scott Galloway, the professor. I know some of you is not a fan of this Scott Galloway, but this book, right, I would say that it's really quite good. And it's quite fun to read also. Highly recommended. What was your purchase price for Nvidia? What is your exit target price? So average price was 14.67. And the last time I bought into this company is really like 2022. I think it's first half of 2022. Like I said, right, in the past 1 or let's say 2 years, I haven't really make a lot of changes in my portfolio. Mainly, if I have money, I think I bought some ETF. So Nvidia is always a concern for me. Like even when I bought the companies, right, bought into the shares, right, the PE was very high, and I will always have these skeptics like, okay, PE is high, so don't over allocate. And right now it's like 20% of my portfolio is because the price went up. It's not because of I keep on adding, right? So I'm always still have this, like so-called the value investor kind of thinking behind my mind that when there's all this hype and when there's like PE is too high, I still try to be more cautious rather than like just all into it just because of AI, right? I can, my mind, I can switch back and forth one. I can debate with the growth investor or that all this Nvidia is not a good investment. I can switch back and forth one. So anyone want to debate with me can come and tell me, let me know. We can have a live session like this and continue to discuss. I can give you top 3 reasons of why you shouldn't invest in Nvidia. High level speaking, how much of priority do you place the subject of capital allocations in terms of generating value for owners? Does it worry you that capital is misallocated in a fast-growing business resulting in complacent management teams, even though growth covers up the mistakes? I think this is a very good question. I don't pay too much attention to this. The main reason is because I think for capital allocations, right, for companies like Berkshire, right, I think it's very, very important because Berkshire, yes, you can still say that they have some core business. For example, their insurance is their core business, their railway is their core business, and so on, right? So there are a number of their business line are their core, and still you cannot call them like they are just a fund. It's not true. They have their core businesses. Overall basis, if you just understand Berkshire, right, it's easier to understand Berkshire as a fund rather than all this core business. Because think about it, right? Warren Buffett, of course, he's capable to run a business, but that's not his interest, right? His interest is really just do capital allocations, just investing. He see himself as investor, so that's the key things, right? So when he structured Berkshire, right, it's more like a holding companies that hold different investment. So even in the early years when he bought over Berkshire, right, it's really just a textile business, and then after that. This business keep on drifting to like owning insurance, owning railway, or owning all sorts of different public securities, right? So it drifted, okay? But still, what these like activities throughout decades, right, is that he is reallocating his capital to investment or to companies that can give him much higher ROE or return on capital, right? So that's the business model. So it's very important for a company or for fund managers, portfolio managers, and so on. I think it's super important for this group of like, managers to do the capital allocations well. So basically, they need to, divert capital from those, let's say, like business that are dying out to those with high ROE, right? That's very true for them. But for the companies that I invest in, right? Say for example, I talk about Apple, I talk about TSMC, right? So for the companies that I invest in, right? Let's say TSMC, you tell them about like what's your capital allocation strategy for TSMC. Yes, they're still doing capex. Those are their capital allocations, right? Still true. But actually, when it comes to their capex, right, it's not like they can suddenly take their money, TSMC take their money and go and invest in media, right? Not true, right? Because they are very core to their business. Their core business is really just chip fabrications. They're just doing chip fabrications. That's the only thing. Of course, they still put their capex to build up fabs. They need to do R&D to make sure that their technology is still the best and so on. So all these things is still true. So they have to do that capex, but that's not capital allocations that same as like whatever Buffett is doing, whatever Berkshire is doing, right? For companies that we invest in, if their core business is very firm, very clear, you know what's their business, there's no concept of capital allocations for those companies, right? Of course, I am the one that allocating all this capital. So it's important to me. But for me, to me, it's like still come back to the same thing, right? My strategy, look for the companies, make sure that they are good, invest, and just hold. So I can show you my let's say let's call it like my purchases, right? I just really hold and then just do nothing, right? Okay, just someone asked about like my Nvidia, right? So these are the report that I took from Interactive Brokers, right? You see, it's like 2020 buy 10 shares. This is all the quantity here are pre-split. So bought all these 2, 3, 8, 6, 10, 8 shares, and then 2022 stop buying already. Just buy and hold. Just hold, like do nothing straight there. So it's already like 2 years that I've been doing nothing. It's already been 4 years or so that I started investing in this company, and just continue with doing nothing. Not really like I don't need to say that this company went up the price and then I need to reallocate because the ROC no longer high. I don't do this kind of things. It's not. It's quite tiring to do these kind of things. That's just my style. I'm not saying mine is the best. I'm just saying that it fits mine because I'm still working. Most of my energies are spent doing work, and then when I have some time, I have some fun with my kids, right? Playing chess. So I don't want to keep on thinking about capital allocations. It's more like overall basis. As and when I look at the pie chart, right? Say for example this, right? I look at the pie chart. I see this is not out of whack. So to me that's good enough. Then I just proceed. Just do nothing or just I don't spend time worrying about that. Do you add to any of your holdings for the previous 2 weeks, excluding this week when the market was undergoing a correction? For me, no, zero. I have not added anything. I have not selling anything. I'm just monitor the market and just I'm shocked with the speed it came down. I'm shocked with the V-shaped recovery, the crisis averted. But I'm watching, just watching. Treat it as entertainment. I'm not knee-jerk into all this market movement. And of course, this is also because I've seen, like sometimes market drawdown, it can draw down for some time, right? Let's say, imagine that we have a correction, right? It draw down for 6 months, right? You don't need to, like rush into that also. So, and some more, if you look at the level of stock market, right? It's still like quite high compared to just, let's say, year-to-date return is still positive, right? So it's not like you are getting a lot of like, upside. Next one, I think this is not for me, right? Let me just read it out. To Raining Gold, if you intend to look for a job, how would you go about your job search, considering you can gauge the job, but how to gauge your manager or colleague? To Raining Gold, feasible to write cover letter, resume, you are looking for a manager whom you can admire along those lines. This is a serious question. I won't go into a lot of details on this. I think this is really questions directed to web. Just one thing for my opinion on the first questions, right? Like, how do you gauge, right? So I'll just say that usually when we go for interview, right, you want to present the best version of yourself because you want to convince the hiring manager to hire you, right? Of course, you do that, right? Interview is not like one side. Interview process is two sides, right? Because if you are confident about yourself, when you go for interview, you don't go for like one job interview, right? You can go for two or three different companies' job interview. And interview is always two-way because you also go through the interview process, you also interacted with the hiring manager. You can ask questions. You can even, ask difficult questions and try to learn. You can do that kind of things, right? And as you do that, you also try to gauge whether this hiring manager is someone that you will find, let's say, comfortable, you will admire the person and you will be happy working with, right? So it's two-way interaction, I would say. That's how you gauge the managers. And of course, the other things which I think is very helpful is really like just try to find out any friends or any friends of friends that work with the company, and then connect with the person. Just, have a call with the person to ask what's the culture, how is it, what is the internal structure. I mean, inside stories that you might find helpful for you to make your decisions. So I think this is, to me, is part of this so-called the due diligence, right? Of course, when we invest in companies, we do due diligence, right? Of course, when you look for a job, you should even double down. You should do like 5x of the work to do the enough due diligence to make sure that it is not a bad move. So that one, I would say, still underrated. Many people don't do that kind of things when it comes to job search. I would highly encourage you to do it. What are your psychological advantage in investing, and how do you cultivate it? Do you think this can be taught to children or teenager? For me, I think one that I think like lacking among especially the younger investors, right, is that they don't have patience. Let's say if you talk about investing with your friends, right, of course you have encountered a situation where your friend told you, oh, I bought into this crypto, I bought into that companies, it went up by 100% in few weeks. There will be situation like this, and it will encourage, I won't say encourage, right? It will entice you to do the same. Like, you also want to get rich quick, right? There's the easier, stable way to get rich, but it is slow, so people are not attracted to it. So I think the patience is really the one that I think lacking among the younger investors. The so-called buy good companies, do nothing, and be very patient about it. I think this one, among the those who are more experienced, I think still okay. It depends on which investor that we're talking about. But for those newer investor, it's a bit challenging. I think probably also because like they, in terms of using technology, using like browsing TikTok, they don't have patience to wait, right? Because everything is instant. So I think that one also doesn't help when it comes to cultivating patience. So I think that's the more challenging part. With regards to how can this be taught to children, right? I would say that, when we interact with our children, right, maybe don't just satisfy them on everything, because for children, sometimes even if they request for certain things, right, you don't give it to them, right? What can they do, right? Because you just think back when we are children, we don't even have a lot of things that our children have, right? So they say they want this, they want it now. Just say no. I'm not going to give you, why should I, Just have these kind of things. I think sometimes I think you don't satisfy everything that they request so that you can toughen them up, right? So because in real world is that Not everything you ask for example, you just go and talk to your boss and ask for a pay rise, right? Your boss won't immediately say, oh, yeah, since you asked for it, I give you 10%, right? It's not like that. So why should we give this kind of things to our children, right? So sometimes I think that don't be too nice to them. You need to, toughen them a bit now, so that they know. Let's say, especially when it comes to the patience part, I would say that sometimes they are very impatient. They want things now, right? Just say, wait. Just wait. I will give you, but next week, right? For example. So don't. I think that kind of things sometimes I think it's good. What worries you the most with respect to the business you own? How do you think about competitions in the chip space that's specific to AI? I think this is very interesting. I think not so difficult. I think I mentioned before, right? Not so difficult to know which company is winning. Not so difficult because, for example, right, you see all this problem about talking about Blackwell, Nvidia Blackwell got some problem. There might be some delay, and then I think the problem has something to do with their CoWoS L technology and stuff. So I think yes, from time to time you can hear that all this news. I read about it. It is very technical, and I will say that I don't understand the details, the technical side of things. But I can still able to gauge. For example, whenever they have problem, right? Let's say this is partnership between TSMC and Nvidia, right? Whenever they have this problem, do they immediately swap up from TSMC and go to Samsung? Actually, no, because all these things is very hard, very tough. It's all new technology. They work very closely together. They trust each other, and there's a deep partnership between these two different companies, right? So even if there's some problem with TSMC's side, right, of all these CoWoS, let's say if they have all these, let's say hiccup when it comes to the capacity, right, the customer have no choice because they just have to wait. Because other competitors, even if you spend money, you divert your business to ask Samsung to do for you, first thing is that they might not able to do. Secondly, even if they are able to do it for you, there's always problem when it comes to the the real work, right? The executions. That's why I would say all these things, right? They have deep partnership. They work together closely. They give chance to each other to we know all these things is hard. We're still working on it. We are solving all these problems. There might be some delay, but we stick to each other. I can sense that this kind of business dynamics and partnership and culture between all these companies. This is true between Nvidia and TSMC. It's also true between Apple and TSMC. It's also true between ASML and TSMC. Because, for example, between ASML and TSMC, right, you have all this problem with their, the fabrications. Machines got problem, they have to contact ASML. So they really go in, then they work side by side. It's not really as simple as, oh, I deliver the machine, that's it. It's not like that. It's really they're working very closely together. They plan their capacity ahead. They share information among each other. So I think it's very, if you read enough, you know the dynamics, you know that so-called competitions is actually not there. One example, right, like Intel, they said they're trying to make their technology the best. You see whether they are able to get all these business back from TSMC, right? I don't think so, because whenever two companies that have deep partnership together, it's like they are married, so very hard to separate one. So I will say that it depends case by case. So that's why for chip or AI, I think I don't think they have problems with competitions. So TSMC will still be there. Nvidia will still be there, so no problem on that. But of course, this is cheap, right? For example, let's say if I talk about Apple, I won't say that Apple is nothing to do with all these things. So there's of course things that worry me. For example, let's say Apple, right? To me, it's very clear this entire mobile phone industry is really matured, and then there's not much growth. So they're trying to find growth in other areas, but nothing. No other things can be as sizable as a mobile phones market. So the risk is that it might become like a dying or a business that is slow down to low single digit kind of growth. If that's the case, it's quite a struggle to, let's say, you can't expect to get let's say more than 10% return if the company become like a 3% growth, and even if they're able to keep their margin, where's the upside, right? So I think that's something that we need to pay attention to. And all these concerns, different companies, different concerns. Thoughts on shareholder turnover, especially when you are a hold forever owner. Does a low turnover keep prices close to intrinsic value or not important to you? Shareholder turnover, I think you are referring to other shareholders that they are selling. I'm not too sure about whether I understand your questions. By the way, I just want to clarify, I'm not in a camp of hold forever. I might sell my positions. It's just that I'm patient enough that I show in terms of my purchase. Some of them is like already hold for 3 or 4 years and I have no intention to sell in near future. But I don't call myself as hold forever because, forever is quite long, right? Even let's call it like 50 years, it's still very long. But I will say that my long is like at least I have no visibility of selling within next 2 or 3 years. So, and the shareholder turnover part, I don't know. Maybe you are referring to other shareholders selling. Like for example, let's say Buffett selling Apple. Is it a concern to me? It's not a concern to me unless really, let's say Buffett he explained in detail why he is selling, and then I might be able to like assess whether how true is his concern and whether I agree or disagree. I can comment on that, but it's not clear why he's selling, so I'm not able to say whether I'm concerned or not, because I cannot just make myself concerned or not concerned by just looking at the actions, right? But I can assess if there's a reason that put on the table, then we can discuss. Maybe he will mention more about that in the upcoming shareholder meetings, which is I don't know, 9 months from now. Okay, questions to web again. May I know you are what religion, or how do you learn to be high moral and happy person even though you seem to lead a simple life? Difficult for us. I thought that let's say if you are, let's say a religious person, right? At least the religion have some teaching that can help you to be like, stay on the high moral ground, right? And also to tell you what to do in your life to help you set your values and your priority, right? At least I'm not like a religious person, but at least based on my understanding on religion, it should be something that can guide you on how to live your life. So I don't know why, let's say if you bring up religion and you say it's difficult, I don't know. I'm a bit struggle to understand where's your dilemma here. Hi, Boon Tee. With the Fed rates reductions coming, there are some opportunities for bond capital appreciations. Any good bonds that are out there, TLT or United SG Fund? My comment on this is that you need to separate two different things. When we talk about interest rate, it's not one figure. The interest rate is a curve. Okay, this is yield curve. Currently, it's inverted yield curve is because, let's say if you buy, let's say like a 3 months or 6 month bond, right, you get like a 5% yield. Okay, just hold until it mature, then you get 5% yield. But let's say if we invest in, let's call it like 5 years, right? The yield is only 3.8%. Okay, the question is always like, why the shorter tenor is better? Why not you just why you like invest 3.8% return and not like those close to 5%, right? It's because let's say if you buy a 6 months bill, right, up and you get the 5% return. After the 6 months is up, right, you take your maturity back and you reinvest later, right, 6 months later, right, you might not able to get 5% already. For sure, you will get a lot lower. So it's more like how much you want to lock in the yield for, like whether you want to lock in for 3 years, 5 years, 10 years, 20 years, 30 years. That's the yield curve that you're looking at, right? Currently, because the interest rate environment is going down, okay, that's why if you want to lock in the yield for longer, of course, you won't get that high of a returns because you lock in for 3.8% for 5 years. If you just hold 1 year and keep on rolling 1 year for 5 times consecutively, really, right? I don't know whether you can get the 3.9% return or not. So that's the trade-off between different tenors. Now, come back to the questions, right? Like when we talk about like Fed cut, right? They don't cut the entire yield curve. They only cut this point. This Fed fund rate is the shorter tenor. That's basically like a overnight rate, okay? So this 5.3 that you're looking at, this one, high, like super high chance that it will come down. But when you buy TLT, you are essentially buying those long-dated bonds. Long-dated bonds are US government bonds with 20 years maturities or more, okay? So it is possible that this rate here, right, come down. This 20 or 30-year rate go up or even not changing, because there's correlation between the short rate versus the long leg. This different tenor, there's some correlation, but the correlation is not 100%. So if you buy TLT to bet that interest rate will come down, don't be surprised that this Fed fund rate cut 100 basis point, but your long long interest rates stay the same or even go up slightly. So it's not a sure win if you buy TLT, even with the Fed fund rate cutting. So just remember on that now. I think this is the part that not everyone appreciate. They might think that, oh, TLT Fed fund is the same, so they will just go ahead. I would just say it's not 100%. So that's my comment. Second comment is that if you think that really, right, the interest rate will come down hard, right, and you believe that the correlation is, there's some correlation, positive correlation, right, and you think that the long interest rate will come down, right, then of course the best, how to best position is to buy TLT. Because TLT is like, there's this duration concept there, right, duration. The long interest rate go down by, let's say, 50 basis point, right, your TLT can go up more than 50 basis point. You can get quite a decent returns just because of the duration, and it's quite long. So that's the right way to do it if you believe the long interest rate will come down. My message to you is just be cautious that may not be true, because let's say inflation just shoot up, right? Your long interest rate might be affected as well. It might go up, so then your TLT will come down. If you look at the price chart of this TLT, also you can see that the volatility is quite high one. It's mainly because the long interest rate, right, is not like Fed fund rate. It's not controlled one. It's really subject to the supply and demand of the long government bonds. So that's why it can fluctuate a lot now. Just be aware of the volatility. Hi, Boon Tee, would you be able to share your experience of investing into the wrong company, and when was it, and how did you conclude that it is time to cut losses and sell? I think if you look at my portfolio right now, right, I think I don't mention those that have liquidated. Those liquidated one is really like I need to pull up the history a bit hard. If you look at my portfolio here, actually, let me enlarge it slightly for you, right? If you look at my portfolio, right, the one that I lost the most is actually Meituan, 3690 Meituan. I bought this actually very, very close to their peak price. And I thought that, okay, China, back then, Meituan is still growing well. This is prior to all the rectifications that came in, right? So I bought into this company, and until now, I still, like bag holder. So I'm bag holders in this. I haven't sell these positions is because as and when they release their financial, I took a look. I think they are not doing like fantastic, but still not like very bad. But of course, all the like the regulations that came in, whatever that hit the business already hit the business. So you can see that their growth isn't as fantastic and as some years back, right? But still, when it comes to their financials, I don't think it is that bad that I need to sell the positions. So that's why I said my position is more like buy and hold. Of course, some investment, right, Nvidia, where buy and hold really give me 700% return. Wow, it's good, right? But of course, there are some buy and hold, and still I lost like 63%, right? So I think buy and hold, it doesn't mean that everything is good. There will be some position like this, money just stuck up there for a long period of time. So it dragged my portfolio return down, and it dragged quite a fair bit, right? But to me, it's okay. It's okay. Not a big problem. Of course, let's say if their result is bad, and then I look at the management is doing stupid things and I don't like it, then I will just reposition my portfolio accordingly. So that's my comment on that. Thank you so much for those who dialed in live. I saw that there's like 26 of you here. Thank you so much. See you in the next one. Bye bye.